This report summarises the results of our financial audits of local government entities for 2015-16, including the 77 Queensland councils. 97% of entities in the sector received an unmodified audit opinion in 2015-16. This means that readers can have confidence that their financial statements are reliable. Only one council and 4 related entities received a qualified audit opinion. While this is a good result, there are still 4 councils and 8 council-related entity audits in progress at the time of this report. The timeliness of council financial statements continues to improve, with 67 councils meeting their statutory deadline and a further 3 meeting their ministerially approved extended deadline. This is the timeliest result in Queensland local government history. 3 councils, Kawanyama Aboriginal Shire Council, Northern Peninsula Area Regional Council, and Woorabinda Aboriginal Shire Council, have not met the statutory deadline for 6 consecutive years. These councils are not focused on enhancing their public accountability and do not prioritise their financial reporting. The quality of financial reporting requires improvement. 21 out of 73 councils made material adjustments to key balances in their draft financial statements before we certified them. Prior period errors that were material to the financial statements were corrected in 7 councils. The majority of adjustments resulted from a lack of completeness of asset registers and the late identification and review of transactions, including asset valuations. While the correction of these errors indicates that councils are taking action to improve the accuracy of their records, they need to put controls in place to ensure these errors do not occur year after year. This year, we identified a total of 723 internal control deficiencies across the sector, of which we considered 235 to be significant or higher risk. Over 76% of significant issues were from Indigenous, resource and rural remote councils. Of these, 45% were also reported to management in prior years and remain unresolved at 30 June 2016. These deficiencies were items such as a lack of maintenance of risk registers, a lack of review of journals and changes to master file data, and an absence of asset management plans. Councils need to resolve these issues promptly, as continuing delays may expose them to increased risk of fraud or error. We performed an assessment of councils' risk management processes and identified that processes are basic or non-existent in at least 20% of councils. These councils do not have complete, up-to-date risk registers, and some do not have risk treatments in place. 16 councils also do not have business continuity and/or disaster recovery plans. A further 20 councils' plans are not up to date or not tested regularly. Risks may not be adequately mitigated in these councils. Councils also may not be able to recover their systems and key business services in the event of a disaster or other unscheduled stoppage. As a result of these findings, we recommended that councils assess the maturity of their risk management practices and develop an action plan for improvement, and assess their business continuity and disaster recovery capabilities, and establish or update their plans. Audit committees have a key role to play in the oversight of risk management, internal controls, and ensuring management takes timely and effective action to address control deficiencies. The requirement to have an audit committee is linked to the categorisation of councils by the Remuneration and Disciplinary Tribunal. Due to a change in categorisation effective from 1 July 2016, 49 councils are no longer required to have an audit committee. We know of at least 5 councils who have already disbanded their audit committees. We made a recommendation to the department in our previous local government report that audit committees be mandated for all councils. The department is currently liaising with stakeholders about this. In this report, we recommend councils retain or re-establish their audit committees to ensure there is effective oversight of internal control frameworks, financial reporting, and legislative compliance. Overall, the combined financial performance of councils has declined in 2015-16, with operating profits falling across the sector by 11% from the prior year. While the sector made an operating profit of $169 million, Indigenous, rural, remote, and resources councils have made combined operating losses of $99 million. For many of the councils in these segments, the lack of economic activity due to remoteness and low populations affects their ability to generate revenue. They are highly reliant on government grants and contributions to fund their operations and construct assets. In our previous reports to Parliament, we have expressed concerns about councils' ability to generate sufficient revenues to fund services and maintain and develop their community facilities and infrastructure. This has not changed in the current year, with the sector, on average over the past 5 years, still spending more than it earns. This result is not consistent across council segments, with South East Queensland councils and coastal councils achieving positive 5-year average operating ratios. For the remaining council segments, this result indicates that they may be financially stressed. These councils need to critically examine their service levels and the costs of service delivery and plan in the longer term to be able to earn enough revenue to meet operational expenditure. Councils face a number of challenges in delivering services to their communities and remaining sustainable. Reductions in government grants over time and instability in other revenue sources due to changes in economic activity can have a major impact on sustainability. Councils should look to maximise revenue from sources other than grants where possible. Expected population increases will also impact the level and types of services councils deliver. Councils need to understand the individual costs of services and how these costs are impacted by the level of services they provide. Armed with that understanding, they can prioritise service delivery based on community consultation and what they can afford. Another key risk to councils is maintaining and renewing their extensive infrastructure networks while operating at sustainable levels. Asset management plans are crucial in ensuring that community assets are maintained and continually renewed to provide the levels of services expected by the communities. We have noted through our audits that councils plan poorly and asset management plans lack substance and rigour. As a result, councils may not have the information they need to make the funding decisions that have significant long-term impacts. Thank you for listening. We trust this presentation has been of value. For more information on the issues highlighted in this summary presentation, please read the full report on our website under Reports and Resources at qao.qld.gov.au.